Welcome, everybody, to the Thursday edition of the Not Your Average Investor Show. Today, we are talking about how much does short-term thinking cost you? What we're going to look at is what does it cost to exit a successful investment early that ages well over time? I believe that we touched a little bit about this on Tuesday. It was kind of a mini teaser, but really comparing the 5 profit centers across the decades, decade to decade, is going to lead to some eye-opening stuff. I'm your host, Pablo Gonzalez, who with me as always in studio here together, my BFF, the guy that I like to call GC because of his genius concepts, because he knows how to generate cash flows, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
You like the extra spice I bring in when I'm in studio, right? I feel like it's just
we've been
different
spicy
energy.
this morning. Started with our run at 5 o'clock this morning. We were excited to be in studio. We're excited to be with you all. It's going to be a great show.
It is exciting to be here. Speaking of being excited to be in studio, we gotta hit on the save the date, folks. We announced it on Tuesday. Everybody's been asking about it. When is the next Not Your Average Investor meetup in Jacksonville? And we officially have a date. February 16th
and February 17th.
February 16th and 17th. We are going twice as big. Last year was 1 day. Today, this time is 2 days. GC's got some real extra special things happening in there, some surprises, some delights, some special guests, some really cool experiences. So if you are planning on joining us, just make sure that you are in Jacksonville by Thursday night, or at least first flight in on, let's just say Thursday night, and you don't leave before Sunday, because it's going to be full Friday, Saturday, February 16th, 17th, 2024.
Wow. It's the first time I've heard that, actually.
Right?
February 16th and 17th, 2024.
2024. Man. We're there. And if you get to show up to the Not Your Average Investor Show, you'll get to learn the faces behind the nicknames that we announce on what, GC?
The roll call, baby.
All right. We got JC kicking us off in the chat, saying a good morning. I know that JC is a name that we know, but it gets populated as JC, and I don't remember. But there you go. We
love you, JC.
We love you. Look at you, JC. All right. We got the maven from the mountains of Denver.
Ms. Leslie Wilson.
Ms. Leslie Wilson. We got the shaman in the house.
Nadeem Shah.
Good morning, good afternoon. We got our friend from Granada, Miguel Angel Sanudo. Good to have you.
Great to see you again, Miguel Angel.
I haven't seen you in a minute. Speaking of somebody that's been on hiatus, our person, he's now from Rockland, California. Formerly from our favorite place to mispronounce, Milpitas, California. Lewis Hudnall, the second chair of Steelers fandom.
I was going to say, huge Steelers fan. It's been a good week for the Steelers, so that must be why we are having Lewis here with us today.
I don't want to make this about me, GC, but ever since I decided to divest from the Dolphins this season and become a Jags fan, now the Dolphins, Jags, and Steelers are all killing it.
Wow, look at you. Yeah, you're a man of the people now.
I had to let go of that dark cloud that was over me. All right, we got Leo Faraganan.
Dun, 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 dun.
Faraganan.
Dun, 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 dun.
Good morning from the Bay Area, California. Let's rock, Leo. Who else we got? Our regulars, Rosalind and Gary Riley from Murrieta, California.
We regard you.
We got the early bird in the house.
Mr. Dean Curry.
Mr. Dean Curry, Columbus, Ohio. We got Margaret Smith.
All right, Margaret, with great questions last time. Oh my gosh,
Margaret
I can't wait for today.
She's back. She said, great topic. Excited to be here. Good to have you here, Margaret. We got Walt Hart in the house. I believe Walt's from Middleburg, right?
I hope so. I think so. Walt, it's great to see you.
I believe we know Walt's from Middleburg. All right, who else we got in here? Denny Davis with his traditional woo pig suey.
Got to do it. Congrats on a great season. Well, I guess you can't call it a great season for Arkansas. They beat the Gators. We'll give them that.
I've had better. All right, we got the ringmaster in the house.
Drew Barnhill.
Drew Barnhill checking in here. We got Cody Adams, our community manager. Cody Adams is checking in. We call her the Mama Bear because she takes care of whatever you need. If you see Cody chatting anything in the chat here, it's because she's here to help you out. She has taken over the Madison role as Madison moves on to continue her career within JWB and grow on to other things. So, Cody, good to have you in here. We got the first family of the Not Your Average Investor Show, Patriarch and Matriarch Ken and Carolyn Moline.
We salute you.
And we got Pamela Myers in the house. Good morning, everybody. So happy to start off with JWB tour dates announced. We're happy to announce it, Pamela.
We are. We're
Pamela,
super
are you coming?
excited.
Are you coming, Pamela?
I hope so.
I hope so. Here we go. All right. We're good. Joe, John Henning. Just shut up. Leadoff hitter. Leadoff hitter.
Coming in at the end.
Batting ninth here. What do you bottom of the order? Bottom of the order today for the leadoff hitter. All right, GC. when you wanted to put this show together, I remember you being like, hey man, what if we talk about this? And I originally didn't really get it.
Yeah.
Why don't you explain it to me again?
Well, I just feel like if people really understood how well this asset ages and performs over time, that this idea of buying and selling quickly would go away, right? There aren't many assets where it has been proven over decades and decades and decades how your income sources are going to work, right? I'm thinking of things like rent price appreciation and home price appreciation. You kind of know how it's going to go in real estate in your specific market. And there aren't many other assets where you can actually use leverage, right? So you're using other people's money. And there aren't many other assets where the majority of your expenses are fixed for that asset. And when you have that, you have this incredible asset that you have created, and you just need to be in the game long enough. And I think people don't really know what that means. When I say that, they don't know numerically like why I love this asset class so much and why I can't get over the fact that other people don't love it as much as I do.
Yeah.
So, with this in mind, I was thinking about, well, what can we teach here on the Not Your Average Investor show? And I said, well, what if we break down how much profit you earn in each decade of ownership from holding the property for 30 years and show people numerically, truly, how much you are earning or how much you're giving up by only wanting to be in this asset for 1 year, 2 years, 5 years, or even 10 years, right? Many people are investing either for themselves or for future generations for 30 years or longer. And so you just have such a consistent asset that has such a track record of profitability over the long haul. And, I don't understand why people don't love it right off the bat. So this is an attempt to show you numerically, right? Look at the numbers, let the numbers guide us here. And hopefully by the end of the episode, you love it just as much as I do.
Sounds good, man. You know what I love about it is that I think I associate you with long-term thinking, and I associate you with a guy that invests in things with compounding returns, right? Like I think of like JWB investing really deep in culture, right? Like in your team, like knowing that over time, people that stay here for 10, 15 years is what provides the best experience for people and that acquired knowledge. Like I think of rental properties the same way. I think about the fact that you guys think long-term. You have one of your founders, one of the people in the suite for you is literally only thinking 10 years out.
Yeah, that's right.
I think that's really, really rare in having an R&D department, right? So like we've talked about this before, but back when we were kind of obsessed with you writing a book, I told you that the title of the book that you should JWB should be long-term mindset kind of thing, right? So I like that you are really trying to crack the nut of helping people understand what's in it for them.
Yes,
to think long term.
Let's make it really clear what's in it for you if you just simply buy and hold.
Yeah, totally. Speaking of long-term mindset and what's in it for them, Lee Bishop MVP, I missed you in the chat, buddy. I'm sorry I didn't say your name, but
the MVP he's going to be a little bit perturbed with that one.
He deserves it.
We love you, Lee.
He deserves better. We love you, Lee. All right, so let's get on to this presentation, GC. First of all, little housekeeping, huh?
Oh, yes. Little housekeeping. Yeah. Anytime that I'm using numbers to help illustrate a point, I want you all to, that you should do your own due diligence, right? The expected returns on investment and the profitability I'm going to show is based on assumptions. And there's different ways to calculate those assumptions, different assumptions you can use and whatnot. So just know that, do your own due diligence, do this before you make an investment decision, any investment decision. And, we're not a financial advisor and we're not offering financial planning advice.
Okay. That being said, let's get into it, GC.
Yeah, buddy. So where do we start?
Well, why don't we talk about what the overall investment over 30 years looks like?
I love that idea. Yeah. Okay. So, what do you know? Those numbers appeared. So, as a part of being a JWB client, you not only just get to think about the transaction today, you have a plan that's built for you. And because we have 18 years of experience of owning rental properties ourselves and own over 400 rental properties and have, managed over 3,000 rental properties for our turnkey clients. We manage over 6,000 properties right now. We know how these things are going to play out over time, and you can start to model your plan. And so what I do is I use that same modeling tool to model out one property that's purchased today with today's purchase prices, today's interest rates, today's financing.
Mm-hmm.
And I say, over 30 years, how much are you actually going to earn from your different profit centers? And there are 5 profit centers. I only put 4 on here. The 5th one is
inflation hedging.
Yeah, it's inflation hedging, and it's a little bit more complex to throw into an evaluation. And the reality is, you can see the profitability there. It's quite large. So we don't necessarily need it to prove the point. So you've got your 4 profit centers here, 4 of the 5. Number 1 is net rental income. Number 2 is tax savings. Number 3 is principal pay down. Number 4 is home price appreciation. Put all these numbers, I'm sure we're going to go over these numbers right here, but your total pie here is large. It's large here. The total profits earned here is almost $1 million over a 30-year hold for just one rental property.
Yeah, that makes sense. And you see, you put in here, I'll go over for anybody listening on the podcast, total profit 30-year hold is $193,000 in net rental income, about almost $19,000 in tax saving, $144,000 in principal pay down, and $633,000 in home price appreciation. As we always talk about, home price appreciation ends up being the biggest part of the pie. When you look at it, GC, I'm doing a little bit of reverse financial engineering here myself. $144,000 in principal pay down. Does that mean we're looking at about like a $200,000 house?
Yeah, $240,000 house. It's actually there in the fine print at the bottom there. I used a $240,000 purchase price. Let's see, I can't even read the fine print. That's what being 41 years old now it does to me. It appreciates, home price appreciation estimated to be 4.8% per year. The actual home price appreciation for Jacksonville is 5% a year, going back since 1982. So went a little bit conservative there. We're assuming you purchase it with 40% down on a 30-year fixed rate mortgage with an interest rate of 6.375%.
Got it. All right, GC. So before we go on to the next look in here, we got breaking news. You were just talking about 6.35%, but there's some breaking news out here.
I gotta be on my toes. I didn't even know that breaking news was coming.
Right? Because it's breaking.
There we go. It's the essence of what breaking news is, right? Yeah, let's talk about interest rates. I mean, that's a perfect segue. Guys, last time, when we did the quarterly real estate update here in Jacksonville, when we did that, I don't know, a month ago or so, we had an interest rate expectation that I think was closer to 6.75% for JWB properties and for JWB clients. That at that time was a lot lower than what was in the marketplace. Interest rates in the general marketplace were getting closer to 8% at that time. Our JWB clients could get 6.75%. But that was then. Interest rates have continued to come down, which is wonderful news. It's wonderful news for everybody. Yeah. Last show, I think I mentioned that they had come down closer to maybe 6 3/8. Now, your interest rate for JWB properties is now down to 6.125% on our evaluations. That means that we're confident we're going to be able to get that interest rate for you, or even lower, potentially, depending on your credit profile and things of that nature. So 6.125% has a dramatic impact on your cash flow, on your home price appreciation, your profitability. All of this is affected, and overall your return on investment continues to go up as interest rates go down. So for all of you who are waiting for interest rates to start coming down, going from 6.75% down to 6.125% is huge. It's huge.
Did I miss an announcement from the Fed, GC, or what's going on back there?
There has not been. The Fed funds rate has been held steady. And this is illustrating this point that we've talked about for a couple of years now, is that there's an indirect relationship between the Fed funds rate, which is what largely gets publicized as rates go up or rates go down. There's an indirect relationship between that and your mortgage rate. And there's a lot that goes into it, probably best kept for another show, but ultimately it is possible for your mortgage rates to go down even if the Fed funds rate is held steady, which is exactly what's been happening.
Okay. All right. Well, interesting stuff, man. Good breaking news. That's good news for everybody, right? Like if you're waiting on the sidelines for something to go down or something like that, like what do is this like a trigger point to go jump on the phone with JWB at chatwithjwb.com kind of thing?
Absolutely. Right. Listen, at the end of the day, this asset is built on buy and hold. And I know how this is going to perform. When interest rates were 6.75%, I knew how it was going to perform, and it probably beats other assets at that time. But if your interest rates come down, that only makes this a little bit better. Right? It's going to perform that much better. So this is a great time for you to jump on the phone, go to chatwithjwb.com, talk with my team, because really when your interest rate goes down like this, many people don't understand this exactly, and maybe we can highlight this on the show sometime, but when your interest rate goes down, what that really means is you can achieve more positive cash flow with the same percentage down, or you can achieve the same cash flow and put less down for your properties.
Okay.
And so either one of those things is a great thing for you, for your return on investment. So this is an opportunity for you to be able to buy a JWB rental property and probably put less money down in order to achieve that break-even cash flow, which we're looking for.
It lowers the entry barrier to break even or positive cash flow, essentially. Sweet. Not too
Absolutely.
bad. Good breaking news. So to recap, JWB rates now at 6.125%. If that is interesting to you, if you want to know what that means, did it lower the entry barrier enough for you to get in? Go to chatwithjwb.com and they can break it down for you however you need it. Personal advice right there. All right, GC, let's get back to these numbers that you put together for us, as you like to do.
Love it.
So we were looking earlier at the total profit of a 30-year hold for a $240,000 home. Total profits earned is $989,391 over 30 years. Now, we said we were going to talk about breaking up into different time buckets. I see that you chose 10 years. Is there a reason why you chose 10 and 10 and 10?
Not necessarily. I could have chosen 5 years or 10 years or 15 years. I think, many people in their head, I don't know, I'm maybe generalizing, but many people are thinking, wow, I can't think about holding something for longer than 10 years. I can't think about holding a piece of property for longer than 10 years. For some reason, that is a mental hurdle for people. So that's why I chose 10 years, which is interesting to me, though, because if you think about how they invest with their retirement accounts and the things that they do with those retirement accounts, you ask them how long they're going to invest there.
I don't even know. 40 years, 50 years? Yeah.
I don't know. 100 years. I'm going to live forever. I'm going to invest there forever. But for real estate, for some reason, they think, it's hard to get past that 10-year threshold.
Okay, so let's not get past the 10-year threshold. Let's talk about the 10-year threshold.
So not every one of these decades is equal here in terms of profitability. So years 1 through 10, your profitability is going to be different than other years. So out of this, call it $1 million pie of profitability that you're earning over 30 years, roughly $130,000 is earned in years 1 through 10. That's not equal to a third of that, right?
No.
So while this is really strong and your returns on investment are 10% or something along those lines right there, this is the least profitable trimester of the 30-year period. I don't know if that plays, right? But it's the least profitable decade, right? Which you can kind of see where I'm going. The longer you hold here, you're going to see more and more profitability.
All right, right on. So then we are looking at a chart right now. If you're listening on the podcast, years 1 through 10, your net rental income is $5,859. Tax savings, $2,665. Principal pay down, $22,308. And still the champion of the world here. Home price appreciation is $96,597 for a total of $127,429 of that total, which is $989,391. Let's look at years 11 through 20. What do you think?
All right. So we're starting to make some serious headway here. Years 11 through 20, you're starting to see some significant gains in net rental income, as well as principal pay down and, of course, home price appreciation. And, I went in a different order here, but as well as tax savings. So let's kind of go through each one of these and talk about why this is gaining so much more in years 11 through 20 than years 1 through 10. I'm going to put you on the hot spot a little bit. All right?
Cool.
The hot seat. So net rental income, years 1 through 10, you only earned about $6,000. Years 11 through 20, you're earning $56,000.
11 times that.
Yeah. Why is that happening?
because rent prices go up year over year while your mortgage stays the same.
Exactly.
Mhm.
That cash flow spread grows year over year over year over year over year. It's growing in years 1 through 10 because you bought the property with break-even cash flow.
Yep.
I mean, at the end of 10 years, you had $6,000 of positive cash flow from net rental income. But that margin just widens in your favor for years 11 through 20 to the tune of, $56,000, right? That's while you earn $6,000 in, years 1 through 10, you earn 10, 11 times that in years 11 through 20.
Got it. Okay. Any other quizzes for me? Any other brain busters?
I don't know. Well, let's see what else we got. So tax savings, the longer you hold on, right?
Yeah.
You're what we haven't shown a lot of light on in the show is for tax savings, right? You get to write off against the income, the rental income that you earn. Well, when you have less rental income in years 1 through 10, you don't get to use the full effect of all of your tax write-offs until your rental income is so high that it outpaces the amount of the write-off from depreciation on the tax savings. So that's the real reason why tax savings grows so much more in years 1 through 10 to years 11 through 20. It's because it's a factor of how much income you're earning now, and then you can maximize the full deduction that you get from depreciation, which is the tax savings component we're talking about.
Interesting. Question in the Q&A from the Maven of the Mountains of Denver. Leslie Wilson asks, I've seen investors liquidate an investment when they have used up all of their depreciation. Can you comment on this?
Yeah, so what Leslie is talking about is you get to write off your property over a period of 27 and a half years. And so when you get to that 28th year, you no longer get an additional net tax savings. No, you don't get to have that write-off in year 28 through year 30 or however long you own the property. And so, I think it's something to be evaluated at that time. When you've owned a property for 27 years or somewhere around there, right? Your life is a lot different than 27 years before when you bought that property. So I think it's a part of a bigger discussion of what's right for you at that moment in time. The biggest things are really, what does your lifestyle require at that time? If you've owned a property for, call it 25 or 30 years, you're probably getting closer to retirement age or in retirement age. And while, the other flip side to this is, while you might not be getting as much of a write-off in your tax savings, your net rental income is so much higher, especially getting close to year 30, because what happens in year 30?
Your mortgage goes away.
Your loan's paid off.
Yeah.
So as you get closer and closer to retirement age, that amount of cash flow, consistent cash flow coming to you is an even bigger priority. And so it's something to be evaluated. I think Leslie's making a great point here, or, ask for a comment on the fact that you would get less tax savings as you get closer, as you get past year 27 and a half. But you also need to evaluate the pluses at that point, which, if you think about where your money can earn the best return on investment for you at that time, with that amount of positive cash flow at that time, it's going to be hard for you to find another asset that produces on a cash flow basis and a return basis. So all good things.
Good. Great question, Leslie. Love it. All right, let's get into years 21 through 30, shall we?
I love it. So we talked about the huge increase in years 1 through 10 for net rental income until years 11 through 20. But Pops, look at years 21 through 30. How much net rental income are you earning?
$131,566.
$31,000.
Yeah, that's amazing.
Over 10 years, 13 grand a year you're earning in net rental income.
It's a lot of money.
And this is even before your mortgage is paid off. This still has a mortgage payment there. If I ran it out to years 31 through 40, it'd be even more eye-opening as far as the amount of net rental income that you're earning simply by buying this asset and letting it do its thing and holding on.
Yeah. And listen, if you're watching on the podcast, I kind of skipped on the year 11 through 20 numbers, but what we are seeing across the board is growing numbers in all the buckets, right? So net rental income went from like 5,000 to 55,000 to 131,000. If we're going to keep it real simple, principal pay down went from 22,000 to 42,000 to 79,000. Why does that happen, GC? Why does principal pay down go up? We haven't talked about that.
Yeah, I'm glad you asked. So, in your loan that you may have with the home that you own or that you own out there, what you'll notice is that your payment every single month to the bank probably is the same if you have a fixed rate mortgage, fixed rate loan. But if you look, the amount of principal that you pay down every single month actually grows. So that's what an amortized mortgage is. It means that in the beginning, you're paying almost everything in interest out of that set payment that you make every single month. And over time, each and every single month, you actually start to see that switch a little bit. And it's slow in the beginning. You start to see every month you're paying more principal down, less interest. Next month, more principal, less interest. And it really adds up over time. And so the way that an amortized mortgage is created is that you're paying the bulk of what your loan payback is in the last third of ownership. And so in other sense, another way of saying this is the most advantageous time for your principal pay down profit center is years 21 through 30. And that's what you're giving up by selling this asset so early.
Yeah, you're giving up on building that equity that whole time, right?
Exactly.
Love that. And then home price appreciation, of course, continues to be the rocket ship, the rocket fuel for all of this thing. 329,000 going from 96 to 206 to 329. And then if we look across the bottom line, right, these like total profits earned over the life of the investment are 989,000. Years 1 through 10 are 127,000. Years 11 through 20 are 313,000. And years 21 to 30 are 548,890. So what you're looking at is essentially total ROI wise, total return wise, you're getting about 1/8 of it years 1 through 10, 1/3 of it years 11 through 20, and almost 2/3 of it in years 21 to 30.
Exactly. Over 50% of the profitability of the asset is in the last decade of ownership, the last third here. And that's what you're giving up. And I would love to hear from the audience if this is new news. If this is, have you ever seen it portrayed this way? Because this is real. This is why I own those 400 rental properties. I've owned them for 18 years now. I mean, it's because I see the value of holding on, and I'm able to, to deal with any type of, bumps that come along the way in terms of maintenance issues or vacancy issues. Is because I got my eye on the prize. I'm looking at years 21 through 30.
Yeah, I think it's interesting that you, as an experienced investor that has lived this, understand this, right? Like, we are showing you the return here of what happens as time goes on. But since you've lived this, you also know that the number one reason you don't get here is because of bumps on the road, right? So you've built a business around smoothing the bumps, right? So like, there's going to be bumps, but you don't really have to deal with them.
Right.
You just got to like psychologically be prepared every once in a while to lay out a little bit of cash into the investment so that it continues performing like it does, but you don't have to do any of the actual work outside of take a couple phone calls here and there, a couple times a month, maybe. And that to me is like the value of it, right? If we can smooth out the ride and make it obvious why you wait to, like why you want to be it for a long term, that's why you are putting these dots together.
Absolutely. That's why we talk about the priorities. If you're a new investor, the priorities that you should go about when making the decision is, number one, the team, because the team is going to actually create the returns on investment for you. But more importantly, the team is going to be in control of the experience for you, because it doesn't matter how much money you make. If you have a poor experience, you're not going to last. Right. So the team has to be the number one and most important thing that you need to do your due diligence on and make your decision based on. Next would be the market, right? The reason why these numbers are really strong is because of the strength of the Jacksonville real estate market. These numbers are stronger because of Jacksonville than if I was doing a similar exercise for other cities that don't have as much rent price growth and home price growth. So next, your number two decision-making factor is the strength of the real estate market, the market. And then your third and final part of the decision, and the most fun and enjoyable and easiest part of the decision, should be the asset, should be the property. If you've done the job well and focused on the team first and then the market second, that team in that market will be able to provide a great asset for you. It should be fun and enjoyable to make a great decision on the property.
Yeah, there you go. So if these numbers make sense to you, you want to get in, you want the team, you want that smoother ride, chat with jwb.com and start talking about how this fits for you based on your financial situation, based on your life situation, and what you got going on. GC, Margaret Smith, as is tradition now,
Yeah.
has a couple of like good questions, good comments. I'm going to start with the first one because I think it'll feed into the second one. She just realized the fine print down here, right?
Mhm.
Fine print, operational expenses, 10% sell, hold close super. Can you just explain that a little bit? What is it? What are we talking about here?
Yes. So when you go and you sell real estate, it is a more expensive asset to liquidate or sell than other assets.
Mhm.
And, I want to make sure that we reflect all of the costs that come along with this holding this asset as well. So in all of our projections, for Margaret or for anybody who's thinking about investing with JWB, we build in those costs into our projections so that you really know what type of profitability you're going to be able to have. And then in this example, I'm going to do the same thing. So, what I do is I basically say, okay, well, at the end of 30 years here, or at the end of each of these trimesters here,
Mhm.
I went and I said, well, what's the market value of the home at that point?
Mhm.
And then I took 10% of that and I counted that as a cost. So it reduces the overall profitability
By 10%.
by 10%. And that 10% is made up of your selling, holding, and closing costs. So think, I'm building in a 6% commission for a real estate agent,
Mhm.
2% for closing costs, 2% for holding costs, things of that nature. So so these numbers here are true what your asset should perform on, including all of the costs, including maintenance costs, vacancy cost, and including any selling, holding, and closing costs.
Interesting you bring up that 6% realtor commission.
Yeah, how about that?
Because we are, as you all know, there has been this like class action lawsuit by the NAR that has essentially called it a monopoly, and the commissions and the state of the realtor and the real estate industry and transaction costs are right now an uncertain future. And we're doing a show about that on Tuesday. So we're going to dive deep into that on Tuesday. What happens if this thing goes away? So maybe at some point, like in 2 years, this is actually like 6% even better, right?
Yeah, I mean, there's a lot of, even if nothing changes based on some of the new potential legislation that is out there, even if that doesn't change, there are so many ways for us to underpromise and overdeliver when it comes to greatly reducing your selling, holding, and closing costs. So it's another opportunity for us to underpromise and overdeliver and get lower than 10% for those liquidation costs.
Yeah, love that. And Margaret, to your question over here, and to honor how good you are at asking these questions, the rest of these assumptions, right? This 6.375% interest rate, that's just like what was out there when you were doing it.
Mm-hmm.
The other assumptions, rent growing at 3.6% per year, operating expenses growing at 3% per year, those all come from what we haven't talked about in a while, which is the JWB data flywheel, right, Tara? Shout out to you.
Mm-hmm.
JWB, now that they have 5,000 properties that they manage in the same locations that are all pretty comparable in Jacksonville, they've been able to, through the years, build up a proprietary data flywheel that essentially tells them how homes are performing here. So these are all real numbers from real performance, not taken from the Kelley Blue Book value of homes,
right,
and not taken from the course you take as a realtor that tells you, oh, by the way, you should make these assumptions when you're going to rent a house or something like that. Mm-hmm. This is all like in-house data from past performance based on what the team can deliver. I thought that was worth mentioning as well.
Absolutely is. It's critical.
And last but not least, Margaret also said, which I agree, a good exercise might be to compare this with a new property every 10 years with all the costs of buying and selling of the 3 properties that affect profitability.
Yeah, we can certainly do that. And, what you'll see is that a new property generally costs a little bit more than a renovated home. And so and they get to the same return on investment equation. So if something costs more going in, it's going to have slightly more profitability over 30 years. But because you had to put more money to get that, your return on investment is going to be basically the same as what it would be for a renovated property. It's slightly less to get in for a renovated property. You'll have slightly less profitability over the years, and you get to that same, call it 9-10% return on investment over 30 years. But we could do that and certainly illustrate that. I think it's a great idea.
I think what she was saying, I agree. We can do it with a new construction home versus renovated home. I think what she was saying is holding a house for 10 years, selling it, buying another one, selling it, buying another one.
Oh,
Which I think
interesting.
would make the numbers
Interesting.
very drastically different.
That would make it very different. Oh man, that's good stuff, Margaret. Thank you for clarifying.
So that's a good, I don't know, man. Maybe future show we talk about like buying and holding for 30 years versus flipping a home every 5 or something like that, right? I think that'd be
buying for 5 to 10, then doing it again, and you can see how much you just lose in tax savings and things of that nature. Oh man, this is good stuff.
Yeah,
I love it.
Really good stuff. We're definitely doing that. Yeah, she says yes, Pablo. Thank you, Margaret. Thank you for validating that. Patron Centurios is in the house. Michael Centurios would love to see the lifetime maintenance over that 30 years.
Yeah.
How does that go up or go down or
so
however it goes?
So maintenance is a percentage of the rents that you earn. So I think we all know that as something ages, there's more maintenance required. Well, that's built into these numbers as well, because as your rents go up 3.6% per year and your maintenance costs are a percentage of that rent, we're expecting more maintenance year over year over year. So we can shine some light on that as well.
I like that. I love it when the community gives us topics. Yeah. This is the best.
Also, we have one, and in that same light, there was a question that came from the community, I think last show or the show before, and it was asked what percentage of residents rent in Jacksonville. So I did the research there. I wanted to get back to you guys on that. 33% of residents in Jacksonville rent. Okay. And so I compared that to the US, 34% of residents in the US rent. So we're right basically in line with that. There's 220,000 residents in Jacksonville.
Renter, residents. You said residents?
Residents, yeah.
Renting.
Yeah.
Because there's more than 220,000 people in Jacksonville.
Well, yeah. Resident. Okay, so now I see what you're saying. Residents. We call the folks that rent our home residents. Yeah. Thank you so much.
Yeah, I got you.
I was like, did I mess something up? And I did. So yes, there's the population of Jacksonville metro area is 1.6 million, I believe.
Somebody just asked me that the other day. I was like, I think it's 1.4.
I think it's definitely 1.6 if it hasn't gone up yet. So, but yes, JWB terminology, the people that are renting homes, we call them residents. Everybody else calls them tenants.
Everybody calls them tenants.
Yes.
But yeah, there is 200, whatever you said.
Thank you.
Renters.
220,000 renters.
Yeah, in Jacksonville. Ken Moline says, interesting, Greg, that if someone follows your 3-property advice by year 30, they would have nearly $3 million in value, all from an initial investment of $600K.
Yes, absolutely. Although I think I can make this a little bit better. Your initial investment wouldn't even be $600K, right? Because you're using a loan here. So the average down payment here might be, let's just say $80,000 all in. So your initial investment is actually, call it $240,000, not 600. But yes, Ken, you're right. There's a reason why you're the patriarch and the first family of the Not Your Average Investor community. It's because you're seeing this, right? It's now you guys see it. All you got to do is buy and hold.
And hold.
That's all you got to do. Yeah. And if you do that, over 50% of the value comes from the holding part in the last trimester of your hold.
It's so funny, man. The Bitcoin broskies are so like hodl. They have a term for it. Hold on for dear life, like buy and hold, buy and hold. And they like worship that. And yet in real estate, everybody's like dying to get out of the investment.
Why is that?
I don't know. And they have that term. I think they say hodl, hold on for dear life. Because of the spike. So it's like dear life. You're like knuckling up and down. Whereas in real estate, it's really much more just like, all right, you just got to lay out a little bit more cash. But like the investment, the stability of it all is so different.
I think people are just like fighting boredom. It's just like too conservative.
I think it's the juice, man. It's the juice.
Yeah, that's the reason why people must make a change. They fight boredom for a long time. And then there's a negative pop and they don't have a team to support them. They're like, I'm out. And they don't realize what they're leaving on the table.
Yeah. Roger Evans popping. He says, thanks for answering the number of residents question.
Oh, fantastic, Roger.
It's Roger. Welcome, also, Michael Santorius had a question. He asked about FHFA rent controls. The breaking news is that Greg is still looking into it.
Michael, thank you for your email, which is fantastic. You guys, when you have show ideas, feel free to send them in. You can send them to info@JWB companies and I'll see them. Pablo will see them. And Michael, I appreciate you kind of connecting the dots on some of the rent controls and some of the other ideas. So I'm checking in. It's a big thing, as you know, Michael. So I'll continue to do some research and I'll bring it back to you guys when I have a take on it.
And Miguel Angel has a question in the Q&A and a comment in the chat. So I'm going to put them together. He says, how long do you recommend to hold a property? 10, 20, or 30? And he says, I presume that when maintenance grows faster than income, it's time to sell. What do you say, GC?
When maintenance grows faster than income, it's
Mhm.
time to sell.
I think Miguel Angel missed the show on Tuesday.
Yeah, I think so.
Yeah,
Miguel,
yeah.
you got to check out the show on Tuesday because I actually debunked that myth right there. Let's start there. So, many people feel the pain of a large maintenance item and they say, or they have felt it and they say, I want to avoid that pain going forward. So they may say, oh, I'm thinking I'm going to sell, in year 10 or year 15, or whenever I think the roof is going to go out or the AC is going to go out. And what they're doing when they say that is they're solving that problem. They might not have that AC or that roof or something that may go wrong, but they don't realize the amount of money that they're leaving on the table. They don't realize how much money they're earning in the other profit centers, even in that same year where you may have a big maintenance expense. So Pablo, I see you being the mad wizard behind here. I think
Miguel Angel. I got a surprise for you, buddy. This was this Tuesday's call where we talked about what it looks like in year 14, 15, and 16 yearly profits.
Mhm.
And we talked about this idea that you got a roof expense, 7,000, 10,000, I don't know, want to call it 15,000, whatever you want to call it. In year 14, your total profits earned when you include home price appreciation and the rest of profit centers is $32,000.
Mhm.
So, and then in year 15 it's $34,000, and year 16 is $36,000. So, in order to your property to outpace maintenance, to outpace returns,
Income, yeah.
income, you would have to be essentially having $32,000, $40,000 a year in maintenance. And that's just not a realistic scenario.
It's not a realistic scenario. When you look at the big picture of profitability, it doesn't usually make sense to do that. It doesn't make sense to do that. You might be asking a little bit more on the income side, on the net rental income. And you might say, well, geez, listen, if I have a $7,000 expense, why don't I save that? Maybe if you're like, listen, cash is king for me right now, maybe that. But then the next point that we talked about was you don't actually know when something is going to go bad. If you know when something is bad in your house, you have to disclose that if you're going to sell it.
Yeah.
And so that would just decrease the amount that you could sell the asset for. So really, if you assume that you don't exactly know when that's going to happen, it's not as simple as just you looking at, 1 year. I mean, you may be off 2 years or 3 years or 5 years. And so that $30,000 to $40,000 of profits that you're giving up, really in 1 year, it's really times 3 or it's times 5 or however off you may have to be. So yeah, it's something that gets thrown around a lot, but when you actually see the numbers of what you're giving up, I think we can all agree it doesn't make a whole lot of sense.
Yep, doesn't make a lot of sense. So great question, though, Miguel Angel. Good that we got to tap into that in context with what we're talking about here. Margaret Smith writes, and pardon if this sounds morose, but we retirees think that way. I don't think this is morose at all, Margaret Smith, for the record. If you pass away, this can go to your kids as monthly income coming in, already safely invested for them, rather than a kid getting a lump sum of money in one big lump and not knowing what to do with that wisely.
I love everything about that comment
100%,
right there.
Yeah.
Many people say, oh, geez, I don't want to own a property. I don't want to keep some of those affairs open. I just want to liquidate and sell and just give my kids, or not give my kids, whatever it may be. And then that makes sense to me for some people. But I think, again, we got to look at it from the other side. What could you be giving to your future generation, right? You could be giving an asset that from an income perspective is rock solid.
Yeah.
Right. We talk about it maybe in years 21 through 30, there's $130,000 of net rental income for the example we just had. That's happening for your future generations. There's the tax savings component. So your tax savings, if you pass and you give this to your heirs, there's a step up in basis, which means your tax saving is way better than what I just put right there. And instead of basically them having to pay taxes on the gains that you've earned, your basis just steps right up. So your future tax liability for them is a lot smaller. Your tax savings is much higher. And maybe we'll do a future show on that because it's not something we've talked a lot about.
Funny you say that, because Margaret did also say she would surely tune in if we ever did an estate planning segment here.
Wow, there you go. Well, that's a big part of estate planning.
Yeah.
And I think she's tapping on something that I can really relate to as well. It's the type of income source that you're giving to your future generation, right?
Mm-hmm.
We all know when you give a huge lump of sum of money, listen, as human beings, when we get a large sum of money, we're usually not the best stewards. If we just get a huge sum of money, we don't know what to do. We might make stupid decisions. We might not make the best return on investment decisions. It's harder. It's harder.
Yeah.
The asset that you could be giving to your folks, to your future generations, could be a pool of performing rental properties that are setting them up for retirement success. And it's happening slowly and growing and growing and growing over time. So that happens to be my viewpoint on why I love rental properties. And I'll just add one more thing too. I think about my kids, and I love thinking about ways that I can help them learn more about being an entrepreneur or being a business owner. And that doesn't mean that they need to be business owners. It's just, how can we use these tools to help them be the best versions of themselves? And I think of a rental property as a beautiful, like, mini business to help my kids learn about how things actually work in the financial world. And so if you think about what you'd be doing for your future generations, you're kind of giving them this beautiful little mini business. And that can be wrapped in with some education, this financial education that I think we're really lacking in this country. So for all of those things, Margaret, I just love your comment. Thank you so much. I just completely agree with you.
Yeah. And, again, not to get morose, right, GC, but I talked to you recently about my dad, right? Like, I talk about my dad on this show, I guess.
We do.
So he's my hero, right? And he recently had a medical problem, which made me think of, hey, what happens when he goes, right? So I had this meeting with him and my mom to talk about, hey, what happens? And he kind of went over everything, and he's got a certain amount of investments, and then he's got this house in North Carolina, and he's got his house in Miami. And I remember thinking in the moment where I'm like, all right, cool. I'm making sure that I know where everything goes if anything happens, and my mom's taken care of and all these different things. And my dad is a super prepared guy. He's got everything figured out. And then he's like, but if we both go, this is what happens. And I was sitting there thinking, I was like, that was the first time that I ever was like, oh, okay, what would my recommendation be with my sister, right? It's me, my sister, and my brother's kids would split kind of the assets 3 ways. And I was just like, man, when that date comes, that house in North Carolina that right now, he lives in half the year, I think we would hold on to that as a family and rent that thing out, right? Like keep that as a Vrbo or an Airbnb. His house in Miami may be a little bit different, right? Like, maybe that's something that you sell, but these properties that are able to produce cash flow that are a little mini business, I started thinking that, man, intergenerationally, that would be something that would bond our whole family of taking care of this thing, enjoying it in whichever way. I very much echo with what Margaret said. I do think that this is a superior form of legacy to leave to the next generation, as thinking from the next generation standpoint.
Yeah, you're adding a whole nother element to it, which is something, a tool to help continue to bond future generations together. Yeah. I think it's special, man. That's a beautiful thing.
That's cool, man. All right, we got a couple more questions before we get out of here. JC, is there a change to how property tax is calculated for investment properties in an LLC in Florida?
Is there a change to how property tax is calculated? Well, technically, there's always a change to how property tax is calculated for your investment property, because it's all based on your tax assessed value for your asset, as well as the millage rate. So it changes every single year. But I think you're asking specifically for LLCs. I'm not aware of any change specifically because of an LLC as far as property taxes.
Okay. And Miguel Angel, last question here. Do you foresee a change in renting versus buying in Jacksonville, as it happened in Europe when people rent less and buy more?
Do we foresee a change in renting versus buying in Jacksonville, as it happened in Europe when people rent less and buy more?
Is that what happened in Europe, or do people rent more and buy less, Miguel Angel? I don't understand. Anyways, do you think that there's going to be a long-term change in the dynamics of this stuff?
Yeah, I lack a little bit of perspective of how it is in Europe. But what we are seeing is that home ownership, the trend for home ownership has actually been going down in the United States, and rentership has become more and more of a desired thing than it has been in the past, which is interesting, because we always talk about what the American dream has been, and include buying a house and a white picket fence and all that good stuff. So I think that definition is changing for people. And I think what you're also seeing is more money starting to flow in to make renting a better and better experience. There's more money from Wall Street. There's more talented individuals. There's more companies that focus on the resident experience, resident meaning renter experience. JWB is one of those companies. And we want to make this a great experience for the resident because number one, we think that's the right way to treat people. And then number two, it's because that's how we deliver the best return on investment for you. So I see more money and more talent and more business and more systems coming into making the renting experience better. I also see less of a demand for home ownership. So I actually, I think that this renting being an amenity is here to stay for a while. I'll just add a side note there. You're starting to see communities that are entirely built to rent communities. JWB has a number of these build to rent communities have these amenities that are just incredible, just wonderful food, dining, other types of options. The way the homes are built, it's community driven, and they're all rental homes. And so this was never done before 5-10 years ago. So you're seeing a lot of movement really to kind of cater to the resident experience. So I think that's going to change. I think that's going to stay.
Awesome. Great conversation going on in the chat, by the way. JC, how can we teach our kids about rental properties and what's a good age to get started? In the teens, they are not so interested. TikTok, man.
Yeah.
You got to give them some kind of TikTok content, I think.
I talk often with my kids about money. I talk often about rental properties. I try to include it in our conversations around things that are very, very normal and mundane, and I try to relate it to my kids. But we talk a lot, and I read books about real estate with them. My daughter has already read most of Rich Dad, Poor Dad, and she's 11 years old. I used to
do not hold your kids to that standard. Bella is a super human being. Just saying.
I was reading that to her to bed when she was, super young. So, it's very intentional for me. I really think this is such a beautiful asset class for so many reasons. So I don't know if there's any magic formula, but I try to include conversations about money and investments and things of that nature so that it becomes a normal topic that is something that my kids feel confident talking about. Cause I think, a lot of folks in our country have just never had any financial education, and it's taboo, and I just don't think it has to be. Right.
Yeah. I agree. I was going to say Hall of Fame first baseman. What's his
Jim Kirko.
Jim Kirko tunes into the show with his teenage son.
Yes.
Right. So people, this is one way to do it. The edutainment side of it.
Yeah. There have been a few folks that have reached out to me and told me they'd listen to the show in the car with their kids when they're driving to work or driving to school with their kids and whatnot.
Yeah. So pop it on JC, pop it on the podcast while you're driving with a kid and you're taking them somewhere, and they're forced to it. You got them captive.
There you go.
Another personal hero of mine, Eddie Yoon, one of the main guys in category design. He plays the money game with his kids, the Rich Dad, Poor Dad money game that I know that.
The cash flow game.
The cash flow game. Yeah. He plays the cash flow game. He's also kind of like incentivizes his kids of just like, hey, I can give you this money to do this, or you can invest it in that. And like, he does stuff like that, gamifying it, I guess, is kind of the move.
100%.
Yeah, 100%. All right. Pamela Myers asks, will email be coming out this week regarding details of JWB tour in February?
Pamela, I'm so excited that you're excited. The email's not coming out this week. We have a few final details to hammer out. We do know that it's going to be February 16th and February 17th. It'll be that 2-day event. So we have the save a date right now. Not ready to release more of those details just yet, but it's something that we're going to be hammering down. And then we'll be creating a way for you all to actually register and get your tickets and get it all signed, sealed, and delivered. We're going to be doing that sometime soon here. So
yeah. Right now you're just in the inside club of the cool kids that know to reserve to put it on your calendar. Just
absolutely.
Last but not least, Anonymous Attendee. Have not heard from our friend from France in a long time. Is JWB doing any syndications for its built to rent community?
Great question. We do not do any syndications for our build to rent communities. You'll notice that there is something that we absolutely know we're going to be able to deliver at certain return expectations, certain client experience expectations. And that really is our turnkey model of investing, and along with private lending as well. And so that's what you'll hear us talk about that we sell. There are other things that we do, kind of like our R&D department, where JWB has build to rent communities. We've worked with other developers to build those build to rent communities out. You've seen our activity in downtown Jacksonville. We've invested $68 million in downtown Jacksonville. You'll all get to see that as being a part of the Not Your Average Investor tour come February of next year. None of that extra stuff do we sell. And part of the reason for that is because cash flows and returns on investment are highly unpredictable there. And I'm not going to take you along for the ride on something that's highly unpredictable. Our value here is consistent, under promise and over deliver client experience. And that's what you get with turnkey and private lending with JWB. So short answer is no.
You could have just said no, Greg. All right. Speaking of which, that is our time today, folks. I want to thank the community. We had the numbers go up while we were on here.
I saw that.
It just got better and better, which is awesome. I attribute that to the great questions in the chat, to the stuff that is happening here that makes this show better. We never take it for granted that you take an hour of your day on a Thursday, middle of the workday, spend some time here, make our jobs easy, make our jobs fun, make this thing really a community thing. Pretty pumped for Tuesday's show. We have not done a Not Your Average Insights in a minute. We're talking about that NAR lawsuit, and we're going to talk about the future of real estate and what that means to the future of real estate. Can't wait to talk about that. We're talking about this interest rates going down. Should you be buying down interest rates? What are plans around interest rates? And also this stat about boomers and what they're doing with their homes, and will that flood the market and what that means. It's going to be a lot of fun Tuesday. Hope to see you there. GC, any final words?
Thank you guys for being here. I also noticed that the numbers went up. So that means that probably somebody was like, hey, friend, family member, hey, you got to jump on, right?
Yeah.
Or at least I hope that's why it was. And I just wanted to say thank you all for being here. We want more people like you on the show. We don't need everybody. We want more people like you. You guys feel how amazing this community is. So if you would be so kind as to talk to somebody who's like you, send them a text, send them an email, tell them to go to nyais.com and have them join the show for the next time. Let's grow this community the right way. So yeah, great show. Super pumped for Tuesday. It's going to be awesome. And thank you guys. It's been a great one.
Any advice for people over the weekend?
Don't be average.